Friday, October 5. The projectionist in front of me has had a brief loss of mind, but she's in recovery. Today's story, the week's story, is really weird, and the full story is in the copy beside the video. But there's an old deal about it. If a tree falls in the forest and there is no one nearby to hear, will it actually make a sound? No, actually it doesn't. This week on Wednesday morning, mortgage rates began a modest explosion. We went from just north of 4.75 to, by the close of today, just about 5.25. And it really all happened on Wednesday in one move, and nobody knows. Now, we know, lenders know, but who wants to be the first lender to tell a client that we're at 5.25 when the client has no preparation and no idea that the entire marketplace has moved, not just us? So lenders are silent. The news media relies on Freddie Mac's mortgage rate survey, which dates to 1971. Big media, Wall Street Journal. I called friends at the Journal on Wednesday to say, hey, this is big. And the editorial response was, we really only run news about Freddie Mac's survey because we know that all of you lenders are lying, thieving, stealing fibbers who would tell us where rates are only for self-serving reasons. So we don't pay any attention to you. Freddie Mac, since 1971, has surveyed the mortgage market and makes hundreds of telephone calls in a methodology that it adopted in 1971, and the markets don't remotely resemble 1971. Freddie makes its calls on Mondays and Tuesdays, and a few more Wednesday morning, and then publishes the results on Thursday, which hit the web on Thursday, but newspapers, print media, big websites, New York Times, that kind of thing, not until Friday. Which means that whatever Freddie found on Monday and Tuesday may or may not be still true by Thursday and Friday. And this week was epic and ridiculous. Freddie, yesterday, 24 hours after mortgage rates had gone to 5 1/8, 5.25, Freddie announced yesterday that mortgage rates were 4.71. Freddie will not conduct a new survey until next week and will not release so much as an electron about the real location of mortgage rates until next Thursday. Crickets. I mean crickets. So I've attempted to place the story on Inman News, and they're going to run it probably later today or tomorrow. The local Denver Post is a really good business reporter, and they're going to run it online probably tonight, and then the print editions over the weekend. And the story might actually propagate from Boulder, Colorado to the rest of the media. Outfits like the Wall Street Journal would not collect news from lenders because they don't trust us. But if a different newspaper talked to the same lenders and found the same news, then it's news. So my colleagues and I have been shocking our client base today by sending out revised estimates and rethinking some numbers that they're in. And anyhow, the world's going to discover next week, and 5 is going to be shocking, but it's just a number. The change in mortgage payments is not a big deal. The housing market is still on fire in really every urban area. The housing market is vulnerable because prices have risen so much, even though there's no inventory. The housing market is not vulnerable because there is no exposed, overbuilt builder inventory to be liquidated. And for a second reason, housing downturns become violent because of the builder discounting their ways out of inventory, but also because of distressed owners who are trapped either in an economic turndown or a home price turndown, and the weak ones then have to go to distressed sales, and that pulls prices down. Good news is that since 2008, if you got a mortgage loan, we dragged you through a bed of hot coals before we gave you the money. And the inventory of weak borrowers and homeowners out there is the lowest in my lifetime. It's a strong group. That's the good news. The reason rates have risen is because the Fed has shifted gears in the last 2 weeks It's dropped all conversation about normal. It's dropped any thought that the Fed might pause at normal. It's been overt in, it intends to hike a quarter point every 90 days until the economy slows down. If we get lucky, the economy will slow down on its own. It doesn't look like that. The bond market, this is long-term money thinking long-term, and if the Fed says that it's going to go a quarter point every 90 days for a year and a half, the bond market thinks, I mean, they're not going to wait for that to happen. They're going to price today for the end game of the Fed. And so the guessing has begun at what point the economy will slow down. And I don't mean to be, at all grim or unpleasant. It's just the way it works. The chance that the Fed's rate hikes stop just at the moment that the economy reaches some nice equilibrium with GDP growth just under 2 and job growth about half of what it's been, those odds are approximately zero. The odds that the Fed will overdo this are extremely high. The only unpleasant future would be actually if the Fed underdoes it. What the Fed is doing is the right thing for the Fed to do. It has to play odds. It has to intercept an economy which is really very hot. And the bad news would be if the Fed sat on its hands and we actually began to run into an inflation problem. And that would mean a much more aggressive Fed and a recession in the near term. Probably not a bad one, nothing like 2008, but that's the way this plays out at this hour of this Friday. A good weekend despite the interest rates, and do have some fun over the next few days as the news media discovers what took place last Wednesday and tries to make news out of what is old. Good weekend.